Everyone, today I'm going to talk about efficiency measure or ratio, as you wish you can call it, of a company. And let's say we have a company, we have an income statement of a company and balance sheet of a company. And for this purpose, we need to find these all ratios. So we have total inventory turnover. It's how a company uses its inventory for producing a product. So how a company is efficient in using its inventory. And for this purpose, we have to take just cost of goods sold because it's our expenses divided by our inventory. It's 1.25, and this shows us how many days a company needs to to use its whole inventory in a year. So in our case, a company needs 202 days to use its inventory to produce those products. It's pretty high, so normally it shouldn't be so high, but in our case, our company has so high ratio, and it shows that the company has to improve the efficiency of using the inventory. The second ratio is accounts receivable turnover, and it shows basically how a company is efficient in collecting money from their customers. And for this purpose, we have to take our sales and divide by account receivables, hence 3.3. And now we have to show how many days a company needs to collect their account receivables from their customers. And it's 100, almost 10 days. It's pretty high, so a company needs 110 days to collect the receivable from their customers. It means that a company has to improve because basically it shouldn't be higher than 30-40 days. At least it can be all 60, but not 110, because 110 a company has to wait so much time to collect money, and a company can just collect 3 times money from the account receivable, and we can see that account receivable 300 is still not so low. The third ratio is accounts payable turnover, and it shows us how a company is efficient in paying its payables for suppliers, for some manufacturers, and so on. So for this purpose, we have taken cost of goods sold and divided by our account payable. It's 2. It means that the company needs about 183 days to pay for their, let's say, for their raw materials to the suppliers or to manufacturers, etc. It shows that a company is still inefficient and the company has to improve still a lot. So the last ratio in this set of ratios is our total asset turnover, and for this purpose we have to take our sales and divide by our total asset. It shows us how good a company using its total assets for each dollar in sales. So a company uses its total assets to make just 28 cents in sales, and it depends on the company. If a company is pretty nice, this ratio should be very high. But if a company, as our company, it's like a small company which has very low net sales, but as well has very low inventory and so on, this company is not so big. So for this company, it can be called that it's pretty good. So if we take all these ratios and we think about a company which has just opened, still small, it's a small business, this company is not so bad. So for these ratios, it's not so bad. But if a company has already stocks and so on, I guess with these ratios, nobody will invest money in such a company. Thank you for watching, and goodbye.